SVB, founded in 1983 and based in Santa Clara, specializes in banking for tech startups and has provided financing for almost half of U.S. venture-based technology and healthcare companies. Although it was not in the same league as, say, Goldman Sachs or JP Morgan Chase, Silicon Valley Bank, or SVB, punched above its weight during its 40-year history. Unfortunately, SVB has become one of the largest lenders to fail since the 2008 financial crisis. During the pandemic, Silicon Valley Bank experienced a surge in deposits due to the tech sector's boom. The bank invested a significant portion of this cash into long-term government securities, which amounted to more than half of its assets. However, the value of these securities began to decrease when the Federal Reserve aggressively increased interest rates to combat inflation. Additionally, there was a decline in startup funding, which caused tech companies to spend their cash reserves quickly and struggle to secure new funding in a challenging fundraising environment. Consequently, startups withdrew their funds from Silicon Valley Bank, and the bank was forced to sell $21 billion in bonds, resulting in a loss of $1.8 billion. The bank said in a filing a day earlier that it planned to sell some of its stock and also seek to raise money from investors to offset that loss. But a call to raise more capital failed, leaving a hole on SVB's balance sheet. The announcement spooked the bank's clients, who got worried about SVB's viability, and then proceeded to withdraw even more money from the bank, a textbook definition of a bank run. The bank's stock began plummeting Thursday morning, and by the afternoon, it was dragging other bank shares down with it as investors began to fear a repeat of the 2008 global financial crisis. By Friday morning, trading in SVB shares were halted, and it had abandoned efforts to quickly raise capital or find a buyer. California regulators intervened, shutting the bank down and placing it in receivership under the Federal Deposit Insurance Corporation. President Joe Biden sought to calm market and taxpayer jitters early Monday. He said that managers of the banks would be fired and investors would not be protected. Customers of the banks, including small businesses that need to make payroll, would have immediate access to their money. He added, no losses from the collapse would be borne by taxpayers, and the money would come from the fees banks pay into the Deposit Insurance Fund. Banks should not be bailed out. They should take responsibility for terrible decision-making. If you're gonna explain the collapse, you should also mention that only 2 days before SVB made the announcement that they needed to raise capital, the CEO, CFO, and CMO sold large amounts of their shares. And the fact that for 9 months the bank had no risk officer. Because otherwise you're putting the fault on the Fed, when it's actually mismanagement from top executives that create a loss of faith and subsequently a bank run. Profits are privatized while losses are socialized.
여러분의 구독과 좋아요는 제가 영상을 제작하는데 정말 큰 힘이 됩니다.